Welcome back, finance enthusiasts. In today's video, we're going to share with you the ultimate guide on how to start investing in 2024. Whether you're a complete beginner or have dabbled in investing before, this video will provide you with the essential knowledge and strategies you need to kickstart your journey towards financial freedom. Before we jump into the actual steps, it's crucial to understand why investing is such a powerful tool for building wealth. Investing allows your money to work for you, generating passive income and potentially growing your wealth over time. By making smart investment decisions, you can set yourself up for a financially secure future. So, let's get into the details. The first step that every savvy investor should follow is setting clear investment goals. Now, you might be wondering, why is it so important to establish investment goals? Well, my friends, having clear objectives is like having a roadmap that guides you towards financial success. Whether you're planning for retirement, saving up for that dream house, or even funding that well-deserved vacation, it's beneficial to have a clear vision of what you want to achieve. By doing this, you'll gain valuable insights into the timeline and risk tolerance that align with your investment strategy. Now, when it comes to investing, it's easy to get caught up in the allure of quick returns. We've all heard those stories of overnight successes and massive gains. Therefore, it's essential to think long-term and be realistic about your expectations instead of expecting quick returns. So, take a breath, evaluate your goals, and make a well-informed investment decision accordingly. Now, I know it might be tempting to jump right into the exciting world of investing, but trust us, taking the time to establish a strong financial cushion to fall back on is absolutely critical. We're talking about the importance of setting aside a portion of your hard-earned income into a separate savings account. This is a game changer. Now, picture this. You're cruising through life, enjoying the fruits of your labor, when suddenly an unexpected expense comes knocking at your door. What happens when life throws an unexpected curveball your way? That's where the emergency fund comes in. Dave Ramsey, one of the US's biggest financial gurus, also has something to say on the matter.
Your emergency fund is not an investment. Everybody say it with me, not an investment. Your emergency fund is insurance. You know what insurance does? It costs you money. It doesn't make you money.
Now that you understand the significance of creating an emergency fund, let's go over the steps to make it happen. Firstly, calculate your monthly expenses and multiply the total by the number of months you want to save for. Secondly, open a separate savings account specifically for the emergency fund and set up a recurring automatic transfer to this account. This will ensure that you are consistently contributing to your emergency fund without even having to think about it. And lastly, make sure to keep this money separate from your other savings or checking accounts to avoid accidentally spending it. By following these simple steps and prioritizing your emergency fund, you'll be better equipped to handle any unexpected surprises that may come your way. When it comes to investing in stocks, it's pivotal to conduct a thorough analysis before making any decisions. So, let's break it down step by step. First off, we need to examine the historical performance of various companies. This involves digging into their past stock prices, identifying any patterns or trends, and understanding how they fared in different market conditions. By doing so, we can gain valuable insights into how these companies have performed over time. One of the first things we want to look at is a company's revenue growth. After all, a company's ability to consistently increase its revenue over time is a strong indicator of its potential for long-term success. But revenue growth alone isn't enough. When you're researching stocks, make sure to remember what Kevin O'Leary has advised.
Are you using any margin?
No.
That's the other thing. Never use margin in stocks. Never do that. Never. People think margin's free. When there's a correction, you get slaughtered.
Right.
They'll sell you out in 2 seconds.
What sets this company apart from its rivals? Does it have a unique product or service? Perhaps it has a strong brand presence or a loyal customer base. These factors can give a company a leg up in the market and contribute to its sustained growth. Of course, we can't forget about the industry in which the company operates. The overall stability of the industry is crucial to consider. Is it a rapidly evolving industry with disruptive technologies, or is it a more mature and stable market? By thoroughly researching and analyzing different investment options, you can make informed decisions that align with your risk tolerance and financial objectives. This knowledge will also enable you to diversify your portfolio effectively, mitigating potential risks and maximizing potential returns. One of the golden rules of investing is diversifying your portfolio. Avoid putting all your eggs in one basket by spreading your investment across different asset classes and sectors. This will help minimize risk and protect your investments from market fluctuations. Remember, investing is a marathon, not a sprint. So, what exactly does it mean to diversify your portfolio?
Make sure your portfolio is diversified. It allows you to take advantage of growth potential and also protects you on the downside. If you have nothing but growth stocks in your portfolio, you're way more likely to have volatility. And if you have nothing but value stocks in your portfolio, you're way more likely to miss out on some rallies. Have some of both.
By diversifying, you're essentially spreading your risk across a wide range of investment opportunities. Now, why is this important? Well, let's say you put all your eggs in one basket and invest all your money in a single stock. If that stock takes a hit, your entire investment could suffer. Now, instead of putting all your eggs in one basket, why not spread them out across different asset classes? That's right, we're talking about stocks, bonds, real estate, and commodities. By doing so, you're not putting all your hopes and dreams into the hands of just one investment. Smart move, right? By incorporating this approach, you have the potential to reap the benefits of various asset classes, as they tend to react differently to economic shifts.
A standard brokerage account is a type of investment account where you can buy and sell assets like stocks and bonds. Often, you aim to buy investments with the expectation that they'll increase in value over time and then sell them for a profit. You might use a brokerage account to save for a short-term goal like a big purchase, or you may be looking to supplement your retirement savings. Brokerage accounts offer a lot of flexibility. Many brokerages don't charge fees to open or maintain your account or to place trades when you want to buy or sell online. With brokerage accounts, there's no limit to how much or how little you can invest other than your budget. And the assets in an account are yours. You can generally sell and withdraw cash or transfer assets anytime you want with no penalties, unlike your 401k or IRA.
Now that you've done your research, it's time to open a brokerage account. There are plenty of online platforms available that offer low-cost trading and user-friendly interfaces. Take your time to choose the one that suits your needs and offers the investment options you desire. But remember, before signing up, carefully read through the terms and conditions to understand fees, commission structures, and any other important information. For example, before signing up for a credit card, it's important to carefully read through the terms and conditions to understand the annual fees, interest rates, and any potential penalty charges that may apply. This will help individuals make an informed decision and avoid any unexpected financial burdens. Consistency is key when it comes to investing, even if you can only afford to contribute a small amount at the beginning. Make it a habit to invest regularly. Over time, compound interest will start working its magic, and your investments will grow. Warren Buffett, one of the most influential investors in the US, sheds light on the wonders of compound interest.
Compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
The best part about it is that it allows your investment to generate earnings on both the initial amount and the accumulated interest. As time goes on, the compounding effect becomes more pronounced, leading to exponential growth. This means that even modest investments can potentially grow into substantial sums if given enough time. However, it's important to note that investing requires patience. The financial markets can be volatile, and the short-term fluctuations are inevitable. As Robert Kiyosaki puts it, money is massive, and it takes time to accumulate this wealth. It's simple to become distracted by the excitement or panic these fluctuations cause, but it's crucial to keep your eyes on your long-term objectives. By maintaining a long-term perspective, you can ride out the ups and downs of the market and potentially benefit from the overall upward trajectory of the economy. Remember that investing is a marathon, not a sprint. It takes time for your investments to grow, and it's important to stay committed to your strategy, even during periods of uncertainty. In summary, consistency and patience are essential elements of successful investing. By making regular contributions and staying focused on your long-term goals, you can harness the power of compound interest and potentially grow your investments significantly over time. Don't let short-term market fluctuations sway you from your strategy. Stay the course, and the magic of compound interest will work in your favor. And there you have it, finance enthusiasts. You're now equipped with the knowledge and strategies to start investing in 2024. Remember, investing is a journey, and it's essential to keep learning and adapting to market changes. Stay committed to your goals, seek advice when needed, and enjoy the process of watching your wealth grow over time. Happy investing.